Hey guys, Sean Pruitt here, president of Kingdom Exploration. I've gone over a tremendous amount of data and information. If you appreciate my efforts and my work here, I'd appreciate if you would help me out with the Google algorithm and please like and subscribe this channel, and also share this video with your colleagues, with your friends, and with your family. It helps me out tremendously. So I have several points here outlining why I believe oil prices will remain strong this year. Number one, Exxon and Chevron's mergers. Exxon's $60 billion merger with Pioneer and Chevron's merger with Hess signal significant consolidation in the oil sector, potentially leading to less competition and higher oil prices. This wave of mergers, echoing the consolidation of the 1990s and early 2000s, could reduce market competitiveness, driving up prices for consumers. Antitrust Investigation calls for the FTC to investigate these mergers for anti-competitive behaviors, highlight concerns over rising oil prices due to decreased competition. Historical context shows that previous mergers have led to increased prices, suggest a potential trend. Okay, so the FTC is getting involved because historically speaking, when they monopolize like this, oil prices do go up. Now, here's a lot of people ask, well, why is that? Well, number one, here's my reasoning behind why these larger oil companies buying out these smaller oil companies and why it will increase prices. Number one, Hess and Pioneer wanted to be attractive to their buyers. So what do? They increase oil output. The more oil output on the books, the more valuable your company is, and the more money you can get from your buyer. Okay, so they'll do whatever. They'll take a well that should be producing half as much and increase it, and that could burn out the well, reducing its shelf life. But what is a company that's about to sell in the next couple months? What do they care if it reduces a couple years off that production? Okay, where a large company like Chevron will come in and they'll have their field engineers evaluate the wells and the remaining oil in place, and they'll dial in how much it should be producing, reducing the amount of oil output. Okay, and that's number one. Number two, ultimately, these smaller companies, it's drill, baby, drill, because the more oil they sell, the more money they make. Okay, where Exxon and Chevron, that model doesn't exactly work with these guys. For instance, they're more interested in making money from their stock than they are from the sale of oil. Okay, now it doesn't make any sense, but today, instead of having these oil men wearing dirty clothes and muddy boots with cowboy hats going into oil fields, now you have these guys in suits using AI and market research and data controlling the direction of where their company goes. And so they realize that, okay, if we spend less money on drilling for oil and more money on giving, buyback shares and also increasing dividends, that increases the value of our stock. And also, the more they produce oil, they learned their lesson from 2012 to 2019. They increased production from 5 million barrels a day to 13 million barrels a day. What happened to oil prices? Man, it dropped down to $30, $40 a barrel. Of course, that had to do with COVID and whatnot, because oil prices dropped 2 times. It was during the financial crisis and during COVID. Okay, but at the end of the day, if the more they drill, the less value of their stock. So there's a balance, okay, where smaller companies, it's drill, baby, drill, make as much money as you can, okay? And so that's a major reason why oil prices will go up with these large oil companies taking over these shale plays, okay? So current crude oil price trends trading above $80 a barrel indicates a significant increase, which could be indicative of tightening supply or an increasing demand driving prices up. OPEC and production cuts. OPEC Plus decision to extend production cuts of over 2 million barrels per day until June is a strategic move to keep oil prices firm. Production cuts initiated in November with significant roles by Saudi Arabia suggest a deliberate attempt to create a price floor, preventing prices from falling too low. Geopolitical factors, supply concerns, increased geopolitical tensions in the Middle East, notably around the Red Sea and the Strait of Hormuz, heightened fears of supply disruptions. These tensions directly impact the global oil supply, potentially leading to higher oil prices as markets react to perceived risk. Now, here's the deal. And I got to be careful what I say, guys. I mean, because, as much as I love to speak truth, I mean, I want my videos to get to more than just 500 people. I want it to get to 500,000 people. And the only way to do that, you got to play ball, okay? Here's the deal. they're trying to keep a tight lid on what's happening in the Middle East. They try to keep it from breaking out into the regional war because, listen, Middle East tensions drives oil prices up, increasing inflation, increasing the risk to the U.S. economy, reducing the ability to get back into office. Okay, and so they did whatever they could to try to keep a tight lid on it, and they tried not to go to war, but they are indirectly going to war with Iran by dropping bombs in Houthi and in Yemen and on Houthi rebels and in Syria and various things. This is turning into a regional war, and the news was involved in trying to keep a tight lid on this thing, although they were reporting a lot of it. But at the end of the day, market sentiment was saying, yeah, we don't think the Middle East is a big deal. But now the markets are starting to recognize, hey, this is pretty serious, and oil prices could be greatly increased because of this. Okay. Now, this was a surprise to me. Asian demand surging, unexpectedly high oil demand from Asia, particularly given China's potential emergence from an economic slump, places upward pressure on oil prices due to increased consumption. Okay. Russia's oil output decision, despite the global landscape, Russia's decided to cut an oil output of 471,000 barrels per day, signals a tight supply market with sanctions in place and a special exemption from OPEC plus. Russia's maneuvering seeks to maintain high export levels, driving global prices up amidst constrained supply. Saudi Arabia budget and oil dependency. Saudi Arabia's reliance on high oil prices, necessitating around $90 per barrel for its ambitious projects, contributes to the kingdom's motivation to cut oil production, adding to upward price pressures. Now, here's the deal. You can't overlook this. The young prince needs $90 oil, okay? No different than, look, let's face it. As a man, we have a tremendous amount of pride in how we provide for our family. The bigger house we have, the nicer cars we have, the better lifestyle we have, that perceives to the world, hey, that's a successful, good man, okay? Now, it doesn't look very good to your following if you are being kicked out of your house because you missed a mortgage payment. That's embarrassing. The pride, the embarrassment of that. Okay. Well, imagine a young Saudi prince running a country. Imagine how he feels. And there are men out there that will murder, that they will kill, steal, and destroy to save themselves from the embarrassment of not having the money that they need. They'll rob a bank. They'll murder someone. They'll do whatever it takes. Well, the Saudi prince, I mean, imagine the whole world is watching him. He's running this country. If oil prices don't go up, he's not going to be able to do these ambitious projects, and the whole world is watching. That would be greatly an embarrassment to this man. So he's going to do whatever it takes, even if it means he has to cheat, okay? Maybe, I mean, and this is kind of crazy. And this is my opinion. This is not fact. But I wouldn't be surprised if these Middle East wars were purely just to put up upward pressure on oil prices. And I wouldn't put it past Saudi Arabia to keep stirring the pot to keep oil prices high. And whatever that means, you could read between the lines. Impacts on sanctions and conflicts. The extension of OPEC plus production cuts coupled with geopolitical conflicts and sanctions, particularly on Russia, underscore supply vulnerabilities. These events collectively indicate constrained oil supply dynamics, potentially elevating prices. Middle East conflict premium. The premium added due to the Middle East conflicts with specific attention to Iran-backed Houthi and attacks on shipping routes acts as an additional factor pushing oil prices higher due to risk of supply disruptions. U.S., Brazil, and Guyana production response. The increasing oil production output from non-OPEC countries like the USA, Brazil, and Guyana attempts to counter OPEC plus cuts, but also adds to global supply complexity, potentially affecting oil price stability with new supply entering the market. Now, I don't think U.S. can maintain its current shale output. Many analysts agree. They've been flat, and we're going to start seeing a decline, okay? And so a lot of this new production is good for market stability and good for the price of a barrel of crude. Let's face it, I don't want to see oil prices go up to $150 a barrel, okay? It's just not good for anybody, all right? I would like to see oil prices maintain $70 to $90 a barrel. That's good for my business, it's good for everyone else's, and it's in America can live with that, and the rest of the world can, okay? And so we need new production. But what my concern is that all of this focus, they redirected capital from oil to green energy. Well, we're seeing that it's not working. and there's just not enough oil for tomorrow. Okay, and so we'll see what happens, guys. But the truth is coming out. Fundamentals are starting to kick in here, and oil prices are starting to remain strong. Geopolitical tensions and attacks on oil infrastructure, direct attacks on Russian oil facilities highlight the sheer vulnerability of oil production to geopolitical strife. These attacks not only disrupt supplies, but also instigate market fears over stable oil availability, contributing to price fluctuation. Okay. And so now here's my bold prediction. Given the outlined dynamics, oil prices are forecasted to experience an upward trend, potentially breaking through resistance levels and reaching up to $95 a barrel in the coming months. Factoring including OPEC plus production cuts, geopolitical tensions, and supply disruptions play critical roles in this prognosis. Investors and market participants are advised to closely monitor developments, particularly in geopolitical spheres and OPEC plus decisions, as these will significantly influence price trajectories. All right, guys, I'm Sean Pruitt, president of Kingdom Exploration. If you like this channel, please subscribe. If you want to learn more about what I'm doing, oil developments throughout the U.S., if you're interested in learning about oil investments, please look in the description below or in the comments below and fill out my form. And if you want the bullet pointed list of the topics that I went over, look in the description. Feel free to read through it. And again, please subscribe and please share this with your colleagues. It helps me tremendously with the Google algorithm. All right, guys, I'm signing off.